day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. Today, we want to look at the Fed statement from yesterday, where they came out and they gave their projections as far as where they see that GDP going for the next couple of years, as well as inflation and that Fed funds rate. So when you look at the release in their statement, ultimately, they continue to see strong labor market that continues to be strong. We see that in the overall numbers in terms of the jobs creation and the wage increases. So we like to see that. We would anticipate that to be higher, that wage increase to be higher than it is right now. But I think with a lot of the different efficiencies that we're seeing come through in terms of the technology, that's kind of weighing that down a little bit. But in terms of economic activity, they continue to see it rising at a moderate rate. Household spending continues to be strong, but we'll talk about that in just a minute. But the business fixed investments and exports remain weak. And we've seen that the uncertainty of these businesses to do those capital projects in terms of where the economy is going, where the trade war, if that will ever end. So we see this business sector unwilling to make these capital investments, and that's continue to keep down the overall GDP. However, in terms of inflation, they continue to see that market-based inflations remain low. They kept the rates the same, which is what we anticipated as well as the market. That was no surprise. When we look at the overall projections that they put out yesterday for GDP, didn't change that much from where they were back in September. In fact, they're exactly the same, 2.2 for 2019, 2% for 20, 1.9 for 21, and 0.8 for 22. So notice, and we've talked about this before, how there's a continual downward trend in the overall expectation of GDP. So that's moving down. It shows that the growth prospects that they're seeing aren't great. Then we look at the overall unemployment. Unemployment continued to remain low, and in fact, they reduced down the overall level of unemployment compared to where they projected it in September. In terms of inflation, they do see it starting to creep back up to that 2%. In here from the 1.5 in 2019 up to the 2%. And the Fed funds rate, they just keep it right where it is, not changing it that much in 2020, and then in 2021 and 2022 showing some potential increases in that rate. So that's a big player when we're thinking about the budgeting process and that Fed funds rate and how it's going to impact your overall pricing on your loans as well as your deposits. That dot plot, we can see those medians there, no change for the rest of this year, obviously. And then for 2020, only 4 individuals suggested there could be a higher Fed funds rate, but most likely will not change. And then we get to 21 and 22. And we can see they continue to move outwards in terms of where that Fed funds rate will go. However, obviously, it must be said that these dot plots have not been a very good indicator of where the Fed is moving, because this is such a fluid market and things change in the economy with the trade wars and with what's going on overseas. So that's just something to keep in mind. But more shorter term, when we look at 2020, we can see the probability of an interest rate hike in 2020 has come down. When we're thinking about GDP right now in the fourth quarter, when we're looking at the GDPNow, remember this is the Atlanta Fed's expectation index in terms of where GDP is coming in at. Now it is at 2% as of the 6th. We can see we got down below 0.5% earlier in these projections. These tend to be volatile. We started off at that 1.5, anticipated somewhere below 2% for GDP right now in our estimation. So we'll see if that continues to move around. We get a new number on the 13th of December. But when we look at GDP for the third quarter, overall up 2.1%. That is very similar to where we had last quarter. But take note, this is the area that we have a pretty big difference in the investment portion. Less of a negative because of those inventory numbers have been replenished somewhat. And also, we did see an increase in that residential fixed investments, which is something we haven't seen over the past 6 quarters. But also within the consumer segment, that contributing 197 basis points, the lion's share of the increase. And notice though, the consumer spending in the third quarter slowed to 2.9% from where it was in the second quarter at 4.6%. So while we did continue to see that growth in the consumer segment, it had slowed down. Thinking about inflation, we can see the 5-year forward inflation expectations has increased over the past couple of weeks, and that we can see that increase kind of correlated with what we've seen in a 10-year Treasury pulling back up close and in the 1.8 mark. So our expectation is that the 10-year Treasury throughout next year is gonna come in around the range of about a 1.5 up to a 1.9. So it's going to move in that range. When it gets up to the higher ranges, that could be buying opportunities in terms of securities. So we got to think about that. But the interesting thing is when we look at that 10-year Treasury compared to that 3-month bill, notice that we were running in that negative yield curve environment earlier this year. And then we saw around this time, around September, the short end of the curve start to come down. If you recall, that is when we had that repo market blip. And we saw in September that repo rate jump up for a moment up to over 10%. Well, then the Fed had to step in, if you recall, and produce some liquidity in that market. And they've continued to do that throughout this time period. In fact, the Fed even said that's going to be the way they will operate into the future, giving no term as well as far as when it will end or how much they're willing to dump into that market. But when we look at the size of the Fed's balance sheet, it kind of gives us some pause here. This is the Fed's balance sheet going back to 2008 when it was under $1 trillion. Then we see the QE movements throughout between 2008 and 2014. So we saw the balance sheet balloon. They started, if you recall, to let the balance sheet roll off. And then we see here in September, it start to shoot up. So when we look at it more closely, we can see in September that they've added a significant amount of money, of inventory to their balance sheet. So we see that now when we look at it, we are a little higher today than we were a year ago. And that's something to think about. They do not want you to think that this is considered a QE4. However, it's pretty dramatic how much liquidity they're pumping into that repo market. And most likely we're going to continue to see this increase over the next couple of months as the banks need that liquidity and keeping cash on the balance sheet rather than pouring it into that repo market. with that being said, that puts pressure on the short end of the curve because right now they're buying mostly bills, and that's going to push down that short end of the curve. So keep that in mind. That's one of the reasons why we've seen that inverted yield curve go away from the earlier part of this year. Combination of the slight increase in the 10-year, that long end of the curve, but more of a dramatic reduction of the short end of the curve. And we saw that with this trending here, where we saw in that September through December time frame, where we saw the short end of the curve continue to move down. So that's what we have for you today. We hope to see you again. If we don't see you before the holiday, have a Merry Christmas and a Happy New Year. Good day, everyone.